Everyone. We want to welcome you here to our PrimePay, or at least one of our PrimePay broker webinars here in the month of August. Thank you for attending our webinar. We know that there are a tremendous amount of competing items out there on your schedule, and possibly one of those being vacations. But seeing the volume and number of folks that are on the webcast here today, hey, I think we might have struck a nerve. So a lot of folks are joining us, and we want to thank you for taking time out of your busy schedule to sit with us today, but also each month as we hold these webinars here for you. So good day, everyone. My name is Steve Jackson. I'm the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and we want to welcome you to our webinar. Now, as most of you are aware, we hold these webinars on the first Wednesday of each month, and we generally try to take a specific piece of guidance or compliance issue or strategy of some sort, and we walk you through that in an hour and attempt to take the complications of the technicalities of those regulations and requirements and put them into practical application. But each year, we pick a month in which we can actually kind of do a grab bag of sorts. So instead of picking just one topic, we get to pick a few topics. And we call this our annual compliance grab bag, right? Because it's a grab bag of just goodness. Just a lot of goodness here, a lot of great information. So as always, we have a tremendous amount of content for you. Before we get started, let's just touch on a little bit of the logistics. We are, for everyone here that is attending, certainly, and those that registered, we are recording this webinar today. We do post these on our Broker Concierge YouTube channel, and I would just ask, give us a couple days, but usually within a couple days, that recording is posted. And certainly, we also want to hear from you. As I go through many of the items today, the annual grab bag webinar here, we kind of go through things with a little bit more speed, okay? So as you have questions, go ahead and type them. Use the GoToMeeting menu bar, the question box there, or chat box, what have you, and go ahead and type in your question. I may be able to address it during the webinar. If not, we will certainly get those answers to you at the end of, well, maybe not at the end of today, but we will get these in an FAQ or what have you. We'll get those answers to you here at some point, okay? So, again, thank you for attending. As we choose to do our annual grab bag webinar each year, I will say that the Affordable Care Act has given us a plethora of good technical items that we can discuss. And as we looked at the webinar here for this month, we again did not come up with any limited number, small number of items that we could discuss. So we actually had to do some weeding out, and we generally pick 5 items that we're going to cover, and so today is no different. But wait. There's a bonus grab bag item. Yes. So we are going to actually provide you with 6 different topics here today, and we're gonna get right into these and dive into the content, each one. So take some notes, write down your questions, type in your questions, because I will go through some of these a little more quickly than others. Okay. So the first one we're going to touch on is the SCOTUS ruling, the same-sex ruling that was made. I just want to reiterate just a couple things on that ruling and specifically how it pertains to the domestic partner relationship. I just want to touch on that. Secondly, here we are going to put a hyper focus as we see this new requirement of forms 1094, 1095C. Applicable large employers are going to need to report. You look at a lot of the data coming from payroll, from the carrier coverage information. Generally speaking, relatively easy as far as the data. But there are some key lines on forms 1094 and 1095C that I'm going to put a hyper-focus link on, okay? And there's really just about 4 lines that we're going to cover, but actually very important lines and very important discussions that you're going to be able to have with your employers. Then we're going to talk about the brand new information that has come out about the increased penalties for ACA reporting non-compliance. Secondarily here, as we go into the next line here, we have, HSAs are, there's a huge growth of employers adopting HSA qualified plans. And as we've seen many questions that have come in, we want to go over this topic maybe more quickly, but we want you to understand and know the rules of the road when you combine two different types of pre-tax benefit accounts together. Then next, groups 51 to 99. I mean, as you're sitting and talking with clients today, maybe they renew generally January 1, and they're sitting in that 51 to 99 space. There could be some early renewal decisions. We are certainly seeing signs where there is movement there to move it from a January 1 to an October 1 and so forth. Well, that decision may be an easy one to make, but do you understand, and does the employer understand that decision and how that decision would affect the transitional relief? Because the reason that they would look at doing an early renewal is to certainly take advantage of the transitional relief rules, right? So we're gonna dive into that. And last, we'll keep it under wraps here right now, but we've got one bonus grab bag item here at the end. So as you look at the gentleman there with the bag over the head, this isn't a grab bag webinar where you're hiding from these items. No. And I couldn't find a guy running as well. So here, this is actually, we just went shopping and we've got a plethora of wonderful items to talk about. So we're really excited about these specific topics. And so come with me as we go through each one, and just hold on to your seats because we're going to go through them. All right, quickly. So SCOTUS ruling, the first item in our grab bag here today is the SCOTUS ruling, the same-sex decision. And what I want to focus on very quickly on this, because I did touch on this briefly on the last webinar that we had, but I felt it probably prudent to just cover it again here in this. So we're going to touch this one here pretty quickly. So, we're not here to discuss and debate certainly the ruling per se, but we do want to understand its impact on how it affects Section 105 and Section 125 plans. So your 105 is going to be your self-insured type plans, and including HRAs. And under 105, you have a dependent definition that's very important under 105B that sets the definition for Section 125 plans, right? So it's just kind of, we need to understand what this decision and understand its impact, okay? So it's going to try to cover more from a cafeteria plan or a pre-tax benefit account update on this. As you know, the same-sex marriage, the decision, it's now stating, it's now a nationwide right, okay? So again, that's a fact, all right? So what I want to focus on here is its effect on domestic partner relationships, okay? So under Section 125 and 105, there's always been guidance relating to domestic partner relationships. One, are they considered a qualifying dependent, a child or a relative of some sort? Should their benefits be taxed or not taxed? Okay. So let's just dive into that, but we'll do it quickly. So first off, just so you understand, this decision really made the domestic partner relationship one a non-effect. So it was unaffected by the court's decision. So that ruling did not touch the current guidance or requirements that are currently placed on domestic partner relationships. So that means that there are no amendments needed for current documents. So under 105 or 125, we don't need to go to clients. You don't need to talk to clients in regard to amendments needed. Okay, so it was unaffected in that regard. But a couple things, just to keep as consideration. What has come of the effect of domestic partner relationships to Section 125 plans or 105? It basically stated that the cost of the benefit that would be provided to a domestic partner resulted in imputed income or taxable income. So, for instance, if an employee with a domestic partner, and let's say they were covered under the medical plan, and that employee was paying $500 a month, just trying to keep things easy, but $500 a month for their medical premium, then under Section 125, and if they were a domestic partner relationship, that domestic partner's share, let's say in this instance, maybe half of that premium, $250, would be taxable, while the employee's share of the premium would be pre-tax, non-taxable, okay? So the premise here is that the domestic partner, their cost of the benefit would be taxed or result in imputed income. One of the things, again, that has not changed, but one that you would continue to kind of see if a domestic partner would qualify under Code Section 105B, that is the dependent definition. And the definition includes an individual being a qualifying child or a qualifying relative. Now, in most all cases, I would say most all cases, a domestic partner would not be considered a qualifying child, so it would not meet that definition, but they could, I would say rare, but could be considered a qualifying relative, and there are certain things that do need to be met or satisfied in order for that domestic partner to be considered a qualifying relative. Now, if they did fall under that definition, that would enable the cost of the benefit to be included as a pre-tax benefit, either under 125 or under under a 105 plan, under an HRA, whatever it may be. Okay. So what I do want to say, though, it is more rare that a domestic partner would fall under those definitions. So it's most likely that the domestic partner's benefit, or that cost of the benefit, would be considered imputed income. So whereas there's not much to do, action item from an employer, documents and so forth, there's still probably a good conversation piece that you could have with your employers, just to say, okay, hey, you do allow this enrollment of domestic partners onto your plan. Just understand, that these rules still exist. This did not change based on the same-sex decision. Okay? All right. We're moving on to the next lightning round. Again, if you have some questions as I go through these quickly, go ahead and go into the GoToMeeting menu bar and you can type in your question there, okay? So this next piece, very important, right? So we all know at this point that the ACA reporting requirements are real. And as we look at applicable large employers, generally those 50 or more, or a self-insured small employer, the responsibilities of these employers have now, they've now increased, right, administratively due to these specific reporting requirements. And we also know right now that these requirements are going to be due in the first quarter of 2016. So, this furnishing of statements by the end of January, and the actual filing, if you do it manually, will be at the end of February, or if you do it electronically, end of March. Okay, so we kind of, we've seen the forms, we've got webinars that are recorded. You can go to our YouTube channel and be able to view, prior recordings of us walking through every single line of these forms. But that's not what I want to do today, because as I've continued to hear from brokers and clients over the last couple months, the data, everyone needs to figure out where to get the data, what data is required and where am I getting it from to get it in the forms. But there are a few lines that are on these forms that have caused a lot of confusion. And so we thought, you know what, let's use this premise here today to really kind of touch heavy on lines 14, 15, and 16 on Form 1095C, and then line 22 on Form 1094C. So for some of you, maybe you're like, okay, I don't even know what you're talking about, so let's dive into it. Okay, so Form 1095C, as you get into Part 2, Part 1, so 1095C, folks, this is the employee statement, okay? So 1095C is going to be generally that main form that will be used when you transmit, certainly to the IRS, but this is actually the statement that would be used for each employee due by the end of January, okay? And so on 1095C, we enter Part 2, and Part 2 of the form covers 3 areas here, 14 and then 15 and 16. So this first one that we want to cover and just dive into a little bit is the offer of coverage, line 14. So as you can see there from left to right, the first column, after the number there is all 12 months. So if possible, the employer would only need to enter a code in one box. If it applied to all of the months of the year, the employer would only put it one time and that's it. But generally, and as you'll see here with some of these codes and the questions, that may not be the case because you're hiring people all throughout the year, right? You're enrolling people all throughout the year. And so each employee can be a little different in regard to how the offer may have been made and when they accepted coverage, enrolled in coverage, declined, any of that stuff. So it is going to look vastly different. So it'll be good for you in your conversation with clients to really help them understand which of these codes truly, truly as far as what that employer falls under, okay? So each of these are codes, so they're going to enter one code either per month or for the entire, they select that first column for all 12 months. So sorry for the acronyms here, but for space, I will cover these here though. So 1A, MV stands for minimum value. So for code 1A, it's stating that this employer offered minimum value coverage and they offered it to the employee at the federal poverty level safe harbor rate. And I'm going to touch on that. I'll just give that brief definition here in just a second. Plus minimum essential coverage to spouse and dependents. Okay, so let me just give you the definition here of the federal poverty line safe harbor. This generally treats coverage as affordable, so it's a way for the employer to offer kind of a uniform rate. If you understand on the affordability clause that the employee should pay no more than 9.5%, right? But there are some safe harbors, and the federal poverty level was one of those safe harbors, and it generally treats coverage as affordable if the employee contribution for the year does not exceed 9.5% of the federal poverty line for a single individual in that applicable calendar year. Okay, so it's applying, instead of the W-2 safe harbor or the rate of pay safe harbor, it's looking at the standard national federal poverty level rates, okay, for an individual. So 1A would be, that minimum value was offered to employees at that federal poverty level safe harbor rate, okay? 1B, as in boy, minimum value coverage was offered to employee only, no minimum essential coverage to spouse and dependents. 1C, minimum value offered to employee and minimum essential coverage offered to dependents, but no minimum essential coverage offered to spouse. And then 1D is just kind of the reverse of that. You offered it to the spouse, but no minimum essential coverage was offered to dependents, okay? 1E, I bolded. So I have bolded this because generally speaking, this will probably be a very common code that your employers will use. Your employers generally speaking, are offering minimum value coverage. They offer it to the employee, and minimum essential coverage is offered to the spouse and dependent. So employers are offering those set of plans, those group health plans, to the employee, spouse, and dependents. Under the rule, right, for the employer mandate, the employee needs to be offered to the employee and their dependents. Right? But I would say most employers today are offering it here under 1E. So 1E is going to be very common, okay? And you could put it just under the first column under all 12 months. But again, depending on when you actually hired that employee, depending on when he was employed, eligible, enrolled, you're going to have to put the specific code to the months that would apply to that specific employee. 1F, minimum essential coverage, not minimum value coverage, was offered to employee or employee and spouse and dependents or employee, spouse, and dependents, okay? So again, just, depending on how you offered that. 1G is self-insured coverage offered to a non-full-time employee. Okay, so could be a variable hour employee in which, from a self-insured basis as an employer, you would utilize here 1G if you offered it to that non-full-time employee. 1H, No offer of coverage was made to employee, or coverage did not meet minimum essential coverage. So I also highlighted 1H because under 1H, this is going to be very common, right? Steve, well, what do you mean? I mean, no offer of coverage. Well, the employee may not have been employed in January or February or March, or maybe I didn't become an applicable large employer until our renewal May 1st. So and based on maybe the offer or what I did or did not have to offer, I didn't offer them coverage earlier in the year. Okay, so the 1E and the 1H, I mean, clearly I think are two codes that you would use on a very consistent basis. And then the last would be 1I, that's an I there, whether qualified offer transition relief applies for 2015. So that would be where, actually, in a relationship that I just had mentioned, if you did fit one of the transitional reliefs for part of the year, let's say, well, then you would put in 1I there as part of that offer of coverage. Okay, so line 14, pretty important. As you can see, you're going to help or need to help assist employers in determining kind of what exactly are they offering, right? Minimum value, only minimum essential coverage, very important, but great conversations. You might have already determined this. I don't know, but it is certainly something from an employer level that they are going to be seeking, well, guidance or confirmation on, and you will become a very strong resource in regard to this line. All right, line 15, a little easier here. I've got a small little paragraph, so just kind of keep following along here with me. So line 15, pretty simple. You indicate the employee share of the lowest cost monthly premium for self-only minimum value coverage. I hate that sentence, but it is what it is. So the lowest cost monthly premium, but it's the employee share, not the COBRA premium, not the aggregated premium, right, that an employer would offer. It's what the employee share of that. So what if these are trick questions here. What if there's only one plan? All right, well, if it offers minimum value coverage, you need to put the lowest cost monthly plan, and this is only self-only coverage. So regardless of the type of coverage they have, you're only entering the self-only premium, okay, that lowest cost. Now, what if there are multiple plans? Okay, again, we're just picking the one plan, that minimum value plan, offered plan, and you're going to enter the lowest cost monthly premium, okay, for self-only coverage, regardless of the coverage that they would have, okay? So line 15, 1095C, pretty basic, but you still, if you've got a fiscal year plan, you could have changed the value middle of the year. So if you had a May 1 renewal, what might have happened is, you changed your contribution levels May 1st. So January through April is going to be set at one amount, and then from May on through the end of the year, a different amount. So again, it's not just this verbatim, hey, here's the number. You do need to consider what changes did occur based on a fiscal year plan or calendar year plan, events that unfolded, it could have changed, in a given year. So just be aware of that. All right, still staying on 1095C, we're now going to go to line 16. And these are the applicable section 4980H, that's the applicable large employers, okay, safe harbor, that's the main section of the code dealing with definitions and regulations requirements around the applicable large employer. This is where we need to enter a code specific to the safe harbor that may or may not apply, okay? So we need to go through this very important piece here in regard to these items. This could, again, change. Can you just put one code in under all 12 months? Yes, but I would say it is going to change just like all the other boxes for lines 14 and 15 will change based on the hire date, the enrollment date, your fiscal year, all of those things. The same thing applies here to line 16. So let's look at these codes. So if no coverage, okay, no coverage was offered, then you have these three codes that would apply if you did not provide coverage. So the first is 2A. The employee was not employed by the ALE, that's applicable large employer member, during a given month. All right, that's easy enough. They were not even under my tutelage during this time, until June. So, at June, we put a different code, but before June, we're entering 2A. They were not employed. 2B, as in boy, employee was not a full-time employee, right? So we, during a specific set of time, this could be for all 12 months, but clearly 2B could apply in certain months where an employee was maybe considered a variable hour employee or was not yet a full-time employee. 2D, as in dog, the employee was in a non-assessable period. So what do we mean by that? You're going to have a new hire that, based under how we are to monitor variable hour employees, if an employee was hired and the facts and circumstances would be, based on the job and responsibilities that they would have, that they would work fewer than 30 hours, then that employee they'd come in as a variable hour employee and would be measured through their initial measurement periods, right? Okay? So what we could see here on these forms is that we have an employee, they're an employee of our company, but this employee was in a non-assessable period, meaning that they were still going through a measurement period, and since they were part of the measurement period, we put in 2D, okay, because we technically would not have to offer coverage to that individual possibly until the end of that specific measurement period. So that's what a non-assessable period. We would not include that employee as someone who would be eligible for coverage until that assessable period has ended. 2C, as in cat, employee enrolled in coverage offered. Okay, I bolded that. Actually, I bolded 2A, B, and D because I think you would use those quite a bit in your codes. 2C, you're going to use this code quite a bit, the employee enrolled in coverage offered. Okay, easy enough. 2E is in Edward, the applicable large employer member qualified for multi-employer interim relief. This is, well, at least with what we see, it's more rare. Potentially there could be some transition relief for more of a MIWA or multi-employer type of a company. For sake of time, won't dive into that here right now because it won't pertain to many of you on that. Please go ahead and submit a question if we need to discuss that a little further. The applicable large employer member met an affordability safe harbor, right? So if you think about the form, line 14 is the offer of coverage. Line 16 is really getting into the affordability, right? Did you make this affordable? Did you offer it? Were they eligible to receive it? And so forth. So an ALE member could have, there's actually 3 different types of safe harbors for affordability. And so 2F is about the W-2 safe harbor, and if an employer chooses the W-2 safe harbor, they must use it for all months, okay? So the W-2 safe harbor, so just so you have the definition, is that it generally is based on the amount of wages paid to the employee that are reported in box 1 on the W-2, right? So I guess I guess the enforcement part of it would say, well, we'd want to look at the W-2 from that employer. What was it at the end of 2015? All right, the W-2 was X. Did that employee pay more than 9.5%? So on and so forth. So many employers are utilizing the W-2 safe harbor because they know, what that, ultimately what that W-2 is going to look like. 2G, as in George there, the federal poverty level safe harbor. Again, here they could use it only for the months that apply. Gave that definition there before, but you're basing affordability on the federal poverty level, so an individual on the federal poverty level rates and table. 2H is the rate of pay safe harbor. Now, again, you would only use this code for the months that apply. Could be all 12, but could be just for certain months that you would have. This actually is going to be used quite a bit, right? Because if anything, an employer does know what the rate of pay of an individual is, and under the rate of pay safe harbor, it allows an employer, based on that rate, if their rate decreases, so if their rate of pay decreases, it enables that employer to change the amount of their contribution so that it's not exceeding 9.5. Now, if their rate of pay increases, they don't do anything. That still stays the same. But it enables that employer to give some flexibility, some movement based on the rate of pay. And so I think we will see many employers utilize this safe harbor 2H and this code specifically. 2I is the ALE member. Are they qualified for a non-calendar year transition relief for the employee? So when you look at line 16, many employers are going to fall under a non-calendar year, a fiscal year, and so this specific item could also apply as well. Okay, so 2I could be used actually quite a bit, or it could be used definitely here with your employers based on a non-calendar year type of a plan. All right, a lot of details, and I see a lot of questions that are coming through, and what we might need to do is just follow up with an FAQ here afterwards that could provide a lot of information. But I hope that I was able to drive some clarity in regard to these specifics. But I do want to emphasize that this is fluid, right? I mean, a lot of things can change throughout the year, and so as an employer, they're going to want to be very conscientious. That data needs to be accurate and current so that they're putting the appropriate codes in these forms. Now, moving to 1094C, line 22 is the main line that I want to focus on that has drawn some confusion, at least out there, as far as what needs to be done. It's about qualifying offer codes, so line 22, certifications of eligibility. And in this case, you select all that apply, so not just one. Okay, you could select all that may apply to a specific employer. So what's a qualifying offer? Qualifying offer is the basics of the employer mandate. An employer of a certain size, 50 and over, generally speaking, is going to need to offer coverage, offer minimum value coverage, offer affordable coverage to the full-time employees and their dependents, okay? So I briefly define that, but that's what a qualifying offer is. I'm offering coverage that's minimum value coverage that is affordable, okay? So qualifying offer method number A, or letter A, let's break this down. So this employer, if this applies to you as an employer, that means that you offered a minimum value plan. It was affordable under the federal poverty level safe harbor for employee only to one or more of its full-time employees, okay, and you offered minimum essential coverage to the employee's spouses and dependents. So you offered affordability under the federal poverty level safe harbor. You offered it to your employees to your employees and also to the spouse and dependents, okay? So depending on the safe harbor that an employer is offering, that might apply. That's qualifying offer method might absolutely apply to the employer, but they would have to be applying the federal poverty level safe harbor, okay, rate, all right? So what this avoids is if the employer selects this, it avoids them entering in the lowest cost employee only contribution, which is line 15, 1095C, on the 1095C, okay? That's it. It avoids entering that if they select this particular method. Now, the last bullet there, in selecting this, if they qualify for this, the AOE member could provide a copy of 1095C or a statement. Ooh, you say, Steve, ooh, a statement. You mean I could avoid not doing a 1095C? Well, it would avoid you having to provide a 1095C to the employee. So this might be good, and I'm not giving any recommendations here. You'll probably hear where I'm kind of going here at the end, but it might be good for fully insured plans. Why? Because for confusion's sake, the carrier is going to be providing the 1095B form to all the employees. And then you're going to give them a 1095C form, with just the employee, kind of information in lines 14, 15, and 16 on it. It's confusing. But here's the catch. remember, you still have to file with the IRS. The employer is still going to have to file 1095-C. So if you're going to have to create a 1095-C, you might as well deliver the 1095-C to the employee. So recommendation might be to just continue to create and prepare and provide the 1095-C as a statement to the employees, but by selecting A, it would enable them just to make a statement, okay, to that effect instead. B, qualifying offer method, transition relief. So if the applicable large employer member makes a qualifying offer to at least 95% of its full-time employees, they could select this. This will only work for 2015. This does avoid entering the indicator on 1095-C, so line 14, okay, that offer of coverage, and they do not have to list the lowest cost employee-only contribution. So it kind of removes the 14 and 15. All right, okay, that's not too bad, but they have to ensure that they did make that qualifying offer to at least 95% of its full-time employees. Could have happened. Now, if they do select this, that would also enable them to potentially write a statement. So it might be prudent, might be a recommendation with those with fully insured plans, but you still need to file, so it may not make a lot of sense. Just go ahead and complete the 1095-C. Letter C is Section 4980H, Transition Relief. This would only apply to applicable large employer members with fewer than 100 full-time employees. Applicable large employer members with non-calendar year plans that qualify for transition relief during months that a penalty would not apply. Now, this could apply to many of the, again, non-calendar year, those 50 to 99 where transition relief applies, but the negative is they could select C, and that's fine, but there's no reduction in data that it allows for. So the employer is still going to need to complete all of the data if they only selected C. They'll get some relief under A and B, but not C. Under D, then, is the 98% offer method, and this is where the applicable large employer member must certify that it offered for all months of the calendar year affordable minimum value coverage to at least 98% of its employees for whom they're filing the 1095-C statement, so it's full-time employees. So they have to certify that they're providing that affordable minimum value coverage to 98% of its employees. What that would enable them to do is they would not need to complete the full-time employee count. That's under 1094-C. It's Part 3, Column B, and it does enable them to not enter that data. Does help. It's nice. So you might have some employers where this particular method may apply. So there's a lot there, right? And I hope you guys will have certainly the recording, slide deck, what have you, to maybe kind of keep this with you, and you can go through it and use it as a resource. But this stuff is pretty important, and you are sitting at a very wonderful opportunity to be able to deliver this message and communicate it so that your employers will fully understand its impact and do it hopefully in the correct way. That's what we want to do. All right, so penalties for non-compliance, right? So our next piece of the grab bag is to provide you the update on the increased penalties for those employers who choose not to participate or participate maybe in a non-correct fashion, okay? So Congress recently increased penalties, and they did this through the Trade Preferences Extension Act of 2015. So let's kind of touch on these, and again, we're going to rapid fire these here a little bit. So if an employer, we understand that these requirements are pretty real and visible, and actually when some of the original regulations came out, the IRS was pretty strong in stating from the beginning that there were going to be penalties. So much like the penalties that exist for an employer around their W-2 processing and reporting, the same types of penalties exist here for the ACA reports as well, but they have increased the amounts of these. So failure, so I want you to keep in mind two things, right? So they need to furnish an employee statement. They need to file returns, okay? So furnish the statement, file the return. So when you look at the penalties that can exist, the IRS will say, well, did you furnish a statement? Did you file a return? But then they're also going to ask the question, did you file accurate data? Did you provide us with the data that we need, that it wasn't messed up? You gave us accurate data and details. So that's where these penalties are really come into being. So the failure to file a required information return with the IRS, that was increased from $100 to $250 per return. I threw an example there just in regard to a 75-person company. Employees would incur with 75 employees, the employer would incur an $18,000 penalty. Now, if the penalties are for both, meaning you didn't furnish a statement and you didn't file a return, then penalties are doubled. So you'd be looking at a $37,500 type of a penalty for that employer if they failed to do both. If failure is caused by intentional disregard, so employer just, chose I'm not doing this, or I'm not doing it in the way that they are asking me to, the penalties then are increased from $250 to $500, and there's no cap limit that would apply as far as the overall penalty that could be assessed. The annual cap, though, is increased. So generally, there is an annual cap, and that has increased from $1.5 to $3 million if a failure was corrected within 30 days. So of that, maybe we had submitted the statements, we recognized errors, the employer then says, you know what, whoa, I need to correct those and get those, done. Now the penalties come back down. That annual cap goes from $250,000 to $500,000. So it wouldn't be at that $3 million mark. It now would be capped at $500,000. Okay? Now, if some of you had known here, this is brand new, right? Everyone's trying to understand how it's going to be done and processed. How are the statements going to be fulfilled, and how are we going to do the filing and all of that, right? So earlier this year, the IRS had announced some transition relief for this year, and it stated that the IRS will not penalize employers that show they make good faith efforts to comply with the requirements. That means, though, that the employer is going to need to furnish the statements on time. They're going to need to be timely with their filing, okay? Now, data could be a little weird, maybe not everything, we got the codes wrong, whatever it may be, right? But as long as that employer shows good faith effort, they basically have said, we're not going to penalize anybody. So this first go around, everybody's in the clear. But this is another great conversation to have. It's not to scare them to death, but it's to really show, look, this is serious stuff. These penalties could be really severe and cost you a lot of money if you don't make every attempt to ensure the accuracy and the timeliness, of these forms and the filing. All right, our next grab bag is centered around our HRAs and HSAs. We are seeing a bigger increase with employers adopting HSA qualified plans. And, as we look at HRAs, sometimes HRAs are not everywhere across the country are people doing HRAs. Some regions, it's so much more than others. But at the end of the day, you have employers that are adopting HSAs at a very strong rate. And under a 2014 Healthcare Trends Institute study, stated that HSAs are offered by 21.7% of employers. So I want you to think about, the employers that you have. What type of plans do they offer here today? Many of your plans, a quarter of your employers are offering HSAs. So an HSA account, a health savings account, you have to be talking about a health savings account for those employers, right? That vehicle is one of the best vehicles for employers to be able to take those out-of-pocket expenses, be able to put dollars away on a pre-tax basis, have those dollars grow pre-tax, but then have those dollars come out of that account on a pre-tax basis as well. It's a wonderful account. But what you don't, or what you want to be very considerate of is if you are talking strategies with your employers and you're combining different types of benefit offerings, different types of pre-tax benefit accounts within or alongside that HSA, you need to know what these rules are if you're going to combine an HSA qualified plan where you want the employee to be able to contribute to HSA accounts, but also have the availability of an HRA as well. And I just want to show a quick example of this because I think it's important to at least understand the rules. If you're going to be talking this strategy, we see this strategy a lot across the country, sometimes in pockets, but all over the country, and you need to understand how to kind of communicate this strategy to your employers. This is actually a very interesting strategy because it focuses here on a couple different things, right? It allows an employee or employer to fund an HSA account. We want that employee, that individual, not to be eligible. We want them to be eligible to contribute to an HSA, but we still want the ability to be able to have that that back-end kind of catastrophic coverage type of protection for employees as well. And that's where this HRA and HSA combination comes in. So let's look at an example here. We have, first off, I list a bullet here. We first are talking about an HSA qualified plan. You cannot contribute to an HSA if you are not enrolled in an HSA qualified plan and, right, you're not enrolled in other disqualifying coverage. So a health FSA, another medical plan, group plan that's not an HSA. You've got to be eligible, right? So we have this example here. It's an HSA qualified plan. The deductible is a $4,000, $8,000. The HSA minimum federal deductible, which is very important to know. Some of you might say, well, who needs that? Well, I'll tell you here in a second. We need to know what that HSA minimum federal deductible is. So if a plan was to be considered, or if a carrier was trying to underwrite a plan to be HSA eligible, one of the key items to make it HSA qualified is that it does not have a deductible that's lower than $1,300 single, $2,600 family. So with this combination now, we have, who contributes to an HSA? Well, we would like an employer and or employee to be able to contribute. And from an HRA side, we know that that's going to be employer only, okay? So with this combination, can we get both? And so let's talk about that. So I just show a quick picture here. And what you'll see here is I've broken out the single deductible and the family deductible. And the green is an HSA. And you'll see here that comes first. That first $1,300, I know I don't have the numbers there right to that, but I just said, you know what, the HSA's right there first. The HRA is not coming into the picture until the first $1,300 or the $2,600 has been satisfied. So in any type of kind of baseline rules when adding an HRA to an HSA plan, you want to ensure that the HRA is not reimbursing any expenses prior to it satisfying at least that minimum federal deductible of $1,300, $2,600. So some of the key rules of the road with this particular type of strategy is it certainly provides the ability to contribute to an HSA, as long as they're enrolled in an HSA plan. And according to the study, probably a quarter or more, I would say in some regions of the country, that's more like 40% of employers or more that have an HSA plan. So many of your employers have the ability to offer or recommend an HSA. Number two, HRAs cannot begin to reimburse until the minimum federal deductible has been satisfied. So regardless of the deductible, the HRA just can't start reimbursing until that $1,300 or $2,600 has been satisfied. But an employer could actually move that. They don't have to start reimbursing right at $1,301 and $2,601, right? I mean, they have the ability to adjust that. The employer can at their whim. Number three is the big one, right? So the reason that this strategy works is that, if the individual is eligible to fund an HSA, and this combination that I'm showing you enables that, then what the employee or employer gets out of that is that the maximum funding by the employer or employee is realized. They can contribute all the way up to the annual maxes on their HSA. That is really cool. And also, if that HRA is coming in on the back end, it's now protecting employees who just, they're going through a rough year medically, and they're maxing or hitting that back end of that deductible. Now the HRA comes in and helps reimburse that. So from an employer aspect, since the HRA is on the back end of that deductible, their risk is more mitigated. They're not going to have that much or as much utilization as if they would have the HRA on the front end. And all the while, the employee can maximize the contributions to the HSA. It really is a cool strategy, but just make sure that your rules are correct, that you have the HSA first and the HRA coming in the second part of that deductible. Early renewal decisions. Our next GrabBag item is an important one. Over the last couple weeks, I have seen many instances where employers are having discussions now of, maybe they sit in that 51 to 99 space. They sit under that transitional relief type of method, but they have a renewal coming up on January 1. What do? Well, could we do like the small group renewals did a couple years ago, and we just try to do a early renewal that way to avoid some of the, or at least the employer mandate aspects, at least for another year? Okay, could. But what we'd recommend is that you carefully consider this option, okay? I think many employers will be able to, if they choose this route, they will be able to do it. But you do need to carefully consider the decision baked around the early renewal versus what it's going to do to the transitional relief that they currently sit under. Because what we don't want to happen, what you don't want to happen is the employer chooses to go and renew, they're going to change their contract to an October 1 contract, and because of changes that were made, they actually now do not come under the transitional relief, which means that they would be faced under the employer mandate by making that change. And the whole goal is to keep that transitional relief, at least for another year, okay? So what I've done here is I put up, there's actually 3 items, and the third one I'm going to cover certainly last, and it's probably the most important, but I'm showing you the first 2. These are pretty basic, right? So the first part of an employer determining whether they would fit under transitional relief is, they fit the FTE calculation. They have at least between 50 but fewer than 100 full-time equivalents, in 2014. So you and the client worked on their calculations to determine, hey, I'm an employer that sits under that 51 to 99 space. Woohoo! All right, so number 1, good. Number 2, maintenance of workforce and aggregate hours of service. So, one of the key things, and this, you guys know where this sits as well, but, did the employer, were they over 100 full-time equivalents, but they decided, you know what, we need to get under 100, so we fit under this transitional relief, so we're going to reduce our workforce, maybe in ways that aren't maybe natural, in order to qualify for the relief, okay? And so what number 2 is really talking about is, did you as an employer, you could reduce your workforce. There's needs of an employer, so that's fine. But if you, needlessly reduced your workforce in order to qualify for the relief, this could take you out of the transitional relief aspect. But most of your employers are going to fit number 1 and number 2, and none all the wiser. All is well. But let's look at number 3. All right. Number 3 is entitled Maintenance of Previously Offered Health Coverage. And just in small words, I suppose, is it's looking back. So this employer decides to do an early renewal as of October 1st. What specific changes did this employer, changing the renewal, make dramatic or drastic negative changes from an employee aspect? And if so, this could potentially remove them from being eligible for this transitional relief. So let's just touch on it. So during the period of February 9th, 2014 through 12/31/2015. So this would greatly affect those employers who would be making a change in their contract here at the end of this year, the 4th quarter of this year. This impacts those employers. So during that period, did the employer materially reduce or eliminate their health coverage, if any, it offered as of February 9th? So you have to go back to this February 9th date. Not that date entirely, but look at February. What did the employer offer? Is it a different coverage than it is today? By making this decision October 1st or November 1st for an earlier renewal or changing the contract, did they end up reducing or eliminating health coverage? Probably not eliminating, but reducing, that coverage. So let's look at these three items. So a couple things that you want to look at, and the one is the first two check marks go together, so it's an either or. Did the employee contribution is at least 95% of the dollar amount that was offered on February 9th? Okay, so as we look back to February 9th, we're in the range of about 95% of what the employee contribution was back in February 2014, or the employee contribution is at least the same percentage of the cost of coverage that the employer was offering on February 9th. So if the employee contribution was 40% of the total, what's the percentage of the premium now? Is it still 40%? Is it 50%? Yeah, what is that amount, okay? And so this is the first two as an either or, and then the third item is, in the event of a change in benefits, the coverage provides minimum value and does not alter the terms of its group health plans to narrow or reduce the class or classes of employees to whom it was offered on February 9th. So did they greatly reduce the amount of kind of eligibility, those employees who would be eligible for those benefits, okay? So some of these, as you look at this, I mean, for many of these, the employer, this is going to be an easy decision. They can go to an early renewal. It's not going to affect their transitional relief. But you need to begin thinking about this, putting this into your discussion pattern, your strategy. So as you're talking about the renewals here with your employers as you head into this fourth quarter, it's important to note that how they change it, if they change the contract in a way that negatively affects materially the employee, then you potentially lose that transitional relief. And again, you don't want to do that. That's the sole reason they're trying to make that early renewal decision. So hopefully that was helpful. All right, bonus round. I know we're in the final couple minutes here of our webinar. You guys have been great. The last item, our bonus item for GrabBag here today, I had to include this because it's come up several times. I'm like, I have to add this. And it's clarifying the embedded MOOP requirement. So the maximum out-of-pocket requirement, so that cost sharing. So as you know, under ACA, there are regulations, right, under ACA that limit how much the total cost sharing expense would be to an individual or family, okay, based on the coverage that they would have. Well, there were some additional findings here in May of this year that affect this particular item. It's very interesting, and if you haven't had this discussion or have dove into it, you need to understand its effect. So embedded out-of-pocket limits for 2016. So this particular rule or requirement is effective for plans or policy years beginning in 2016. So it's either on the calendar year or when the plan actually renews, okay? This affects all non-grandfathered group health plans, which include self-funded plans and the large group health plans. So if I just read that correctly, yep, that's everybody. All right, so this is all plans. All right. If you want some further guidance, you can seek out the May 26, 2015 FAQ from HHS. It's part 27, if I know my Roman numerals there. So that's the number there where you can go back. Now, let's dive into this, though. So what does this mean? Embedded, out-of-pocket limits. What do you mean? So the basics is this, and it's wrapped up in this statement. The self-only out-of-pocket limit applies to each individual regardless of coverage. So if that employee, that individual, they're covered under a family plan and the maximum out-of-pocket limit is, in this case here, new limit is $13,700, doesn't matter. Nope. If they have a certain amount of expenses, their cost-sharing limit is set at the individual rate of $68.50. Okay, so the new out-of-pocket limits for 2016 are $68.50 for self-only and $13,700 for other than self-only coverage. So I show here an example for a family of 4. We have an aggregate for, an aggregate annual limitation of $13,000. So I didn't show $13,700 because health plans can, they don't have to be at $13,700. They don't have to be at the maximum. They could certainly be lower, and actually many plans are lower. So based under the FAQs, I thought it was a great example in the FAQ, so I've just taken that so you can kind of read through this here again in the FAQ when you look at it here a little later. So there's a $13,000 annual limitation. Let's just assume here we've got an $8,000 deductible for family. It's kind of insignificant here based on the example that we're showing. So family member number 1 incurs a $10,000 or incurs $10,000 in cost-sharing expenses, hospital stay, whatever it may be. Family members number 2, 3, and 4, they each incur a $3,000 cost-sharing expense. Family member number 1 is limited only to the $68.50. So they, even though the deductible may be $8,000, okay, the family member is limited now to the $68.50 in the cost sharing, and the plan is required to pay the difference. Okay, so that difference between $10,000 and $68.50. Okay, so the entire family is then limited to $13,000 in total cost sharing exposure, but the family member here that had incurred more than the $68.50 will only be responsible for the $68.50, and that's where we get this embedded kind of deductible or embedded out-of-pocket limit, okay, and cost-sharing limits, okay? That's the extent. That is the key. That's a really good example, at least, to showcase kind of what that self-only out-of-pocket limit and how it would apply. So just a couple things to consider here as you think about this particular item. Considerations include just HSAs. I mean, HRAs are in the mix as well, but think about HSAs a second. The high deductible health plan maximum out-of-pocket, as it's listed for an HSA qualified plan, is $65.50 and $13,100. Okay, that's different. It's lower. Okay, so it's more. It's better for an employee. So since it's more, open, less restrictive, then certainly it would be allowed. But just understand that an HSA actually has different limits, and I just put the contribution limits of what an employee could contribute to their HSAs for single and family coverage, 2015-16. Also keep in mind that an HSA, generally the family coverage is just one aggregate deductible. Okay, well, we've got something different here now. Now, an individual under ACA rule cannot have more than that $68.50, okay, as an individual for cost-sharing purposes. So it is important to understand that here going forward here into 2016. Implications for group health plans, yeah, cost. I tell you what, we've already talked to carriers, based on this particular rule and requirement, premiums are going up. I mean, you now are putting more risk. Underwriting is going to look at this differently, and they're going to apply more cost, more premium cost to this because of this piece. Exposure, certainly some additional exposure to the employer. To the carrier based on this particular result requirement. HRAs. I mean, you do want to look at the current HRAs and how you are establishing HRAs for your clients. Does the HRA plan design, does it somehow interact differently now because of this embedded out-of-pocket cost-sharing limit, right? So I would evaluate your HRAs. I would look over those to ensure that, we're not going to, maybe we need to repackage them a little bit based on this new requirement. So very important. You should definitely be talking about this very important piece of requirement here with your clients. It affects all non-grandfathered plans. So what should be your next move? When we show the annual compliance GrabBag webinar, I mean, there's so many things here, but when you look at all of these requirements, I'd say each of your clients are being affected by at least one of these, right? As we looked at kind of priorities, ACA reporting compliance is probably the top priority. And I think you as a benefits broker, you need to understand where you bring the best value. I'm going to tell you right now, you guys are looked at as the trusted advisor in this fashion. CPAs and accountants do not know or understand the requirements for 1094, 1095. They don't. There are some, clearly, but as a whole, they don't. So your clients are going to be looking to you, and you can bring a tremendous amount of value, through these requirements. Create a simple checklist. There's an easy way, utilizing the presentation that I provided today, just to start going through some items that your employers are going to need to follow. I would say this, because I'm an eternal optimist, but where legislation creates hurdles, you got to focus and continue to focus on existing and new strategies that we can remove these barriers. There are, just as I mentioned with the embedded out-of-pocket cost-sharing limit now, there are probably some strategies with HRAs and HSA types of plans where you could create a benefit offering that will not impact an employer, certainly, in regard to this new requirement. So think outside the box. Think about how you can help that client through that specific requirement. And then having these conversations truly puts you in a huge consultant role. They need somebody, and it is going to be you. And you just sit in a wonderful place. If you're willing to take it, you can help clients really chart their course, kind of map their course through all of these requirements and specific business issues that they are facing. As we wrap up here, I want to just mention a couple things. We have a special promotion here that we've actually brought back. This is actually very exciting. We're excited to be able to bring this to you. This is specific to you and your agency, but actually any referred client that you provide. So what we are doing is if your agency comes on our payroll services or you refer a client that starts on our payroll services between now and October 31st, so we got some time, you and your clients will receive 60 days free of payroll services. Very cool. This is only available through our broker channel. So this is a promotion that's specifically for your agency. If we're able to earn your business on the payroll side just for your agency, but certainly for any of your referred clients that you would have. So we're excited about that. We also have a couple exclusive pieces that we are bringing forth here to our broker concierge partners. So this is an exclusive. As a broker concierge partner, I had mentioned here a little earlier, what are some things that you could do? Well, you could create a checklist. Well, wait a second. I've created the checklist. We've done it. We have created a 4-page benefits program checklist that covers a comprehensive list of all these items there that I have on the left. And this is not meant to be the absolute, hey, this answers all the questions, but it allows you to sit down with your clients and ensure that your clients are fulfilling their obligations under the various requirements of all these different things, COBRA to HIPAA to ACA, general compliance questions, plan documents and notices, and so forth. As a BC partner, we will be providing this to you. So for those who have registered and attended today, you will be receiving this in our follow-up email. What we also want to continue to mention, we've had many BC partners also take us up on this exclusive offering with the ACA reporting requirements being such a priority. We are doing more and more of these client webinars, and we'd ask that you take us up on a client webinar or seminar for your agency and your clients. And we would love to participate. We've got a lot of good topics. You might have some as well. Let's work together in driving great education and communication to your employer clients. That's some strong value. The last item here then is just as far as what we'll do to follow up with you here today. For our broker concierge partners, you're going to be receiving the links to the recording, the presentation slides, the benefit program checklist, but everyone's going to receive certainly the link to the recording. Certainly the 60-day free promotion is for everyone. And certainly those members, those of you who attended today who are not a broker concierge partner, we would invite you to look into our partner program. We'd love to talk to you more about it, and I would ask you to reach out to our Broker Concierge team at the numbers there to the right, and feel free to reach out, and we can share more about how to become a partner with PrimePay. I want to thank you so much for your attendance today. We had a large amount of folks on today, and just thank you so much for taking time out of your busy schedule to sit with us. Our next webinar will be coming up here the first Wednesday in September, and we are just very grateful that you have partnered with us. We look forward to working with you through your busy season here this fall. And so with that, thank you for attending today's webcast, and this will conclude today's webinar. Take care and have a great day.